Thank you. Good afternoon, everyone, and welcome to the Libor session. I will spend the next few minutes presenting on the impact of the Libor transition on the banking industry. As we are aware, Libor will cease as a benchmark interest rate or benchmark index rate for new instruments from January next year. And I will spend a few minutes presenting on the impact of that transition on the banking industry. My presentation this afternoon will cover three main aspects regarding the Libor transition. I will also discuss the readiness and implications for the banking industry, as well as the alignment and harmonization of pricing for debt portfolios and derivative products. My agenda is structured over three areas, looking at an introduction and a recap to Libor, some discussion around market developments, and then closing by discussing the transition impacts and what banks like yourselves can begin to do to prepare for the transition away from Libor. So I will kick off with a general introduction and background on Libor, a quick recap on the soon to be replaced Libor. Libor is an acronym for the London Interbank Offered Rate. It has been dubbed at times as the world's most important number. Libor is a reference or benchmark interest rate commonly found in financial contracts and products within the financial services industry. So when you think about your derivatives, your debt portfolios, and other contracts, you would find Libor quite prevalent in many of those types of arrangements. Libor has been published since 1986 at approximately 11:55 GMT. Libor is determined by a select panel of banks who submit their transaction rates, and is calculated using a waterfall methodology at three levels. So you have the transaction-based, transaction-derived, and the application of expert judgment. Libor is also issued in 5 currencies in 7 different maturities. So when you combine the number of currencies and the different maturities available, you end up with 35 different Libor settings or Libor rates that are being computed. And you begin to appreciate or get an indication of the level of complexity that goes into the derivation of Libor rates themselves. Now, moving on this slide, you get to see and appreciate the wide range of financial products that are impacted by Libor. As noted earlier, it is a benchmark interest rate, and it affects a wide range of products within the financial services industry, particularly the banking industry. While this slide highlights the degree or extent of that impact, you will appreciate when it comes to products within the sales and trading desk, when you think about the corporate banking space, the asset management space, retail banking and wealth management, when you look at the host of products within these banking segments or banking businesses, then you begin to appreciate the wide range of impact that Libor will have on the portfolios and many of the products within the banking industry. We have at least $35 trillion worth of exposures to Libor that are going to be maturing post-December 2021, the cutoff date this year. And that begins to tell you the level of complexity for the contracts that have to be moved or transitioned away from Libor to the new alternative reference rates. And at the end of 2021, when you look at the relative exposures, you have about $28 trillion of OTC interest rate swaps about $2 trillion of OTC cross-currency swaps, which are going to be maturing beyond December this year and will have to be thought about from a transition perspective away from Libel. So that gives you an appreciation of the range of products that are impacted by Libel. This slide gives an overview of the alternative reference rates that will be replacing Libel. So you have the SOFR, which will be replacing the USD Libor, SONIA to replace the GBP Libor, ESTA, the Euro equivalent, SARON, the Swiss francs equivalent, and TONA, the yen equivalent. Also on the slide, you'll find the various features highlighted, such as the working groups that are responsible for the alternative reference rates for each jurisdiction and guiding the transition program in each jurisdiction. You also have an indication of the data source, the administrators, and you also have the nature of some of the replacement rates. Some are going to be secured, while some are going to be unsecured replacement rates. The methodology is largely transaction-based, which when compared to what I mentioned earlier from a Libor perspective, was a waterfall 3-based methodology approach. And when it comes to the availability of term rates, we begin to see a lot of activities in that space regarding the replacement rates. And we are finding that there's been a lot of activities in the development of term rates for the replacement rates as well. Now, how are these new risk-free products different from an operational perspective? So when you think about the replacement rates, how are they operationally different to what we currently have under Libel or the soon-to-be replaced Libel? 5 areas we just wanted to bring to your attention. The first one being the term versus overnight rate. Libor rates are set in advance of the interest period. This is a key feature borrowers find particularly pleasing. However, you find that the replacement rates, for example, the SOFR, would reference an average over the current period. And there are already discussions on the implications of this on the basis spread and some of the operational workarounds regarding term and overnight rates. From a publication time perspective, Libor is published at 11 a.m. London time. SOFR, for example, is published 8 a.m. Eastern time +1 for prior day transactions. This feature alone could impact the amount of time borrowers have or notice before payment is due based on the use of the arrears convention for many of the replacement or alternative reference rates. And therefore, you then find that operationally, this could pose some sort of challenge to many of the users of the replacement rates. When you think about it from a reference rate linkage in contracts, Libor rates have been directly referenced in contracts. However, because of the arrears convention, you find replacement rates, particularly the SOFR, for example, we have payouts in instances that will be typically linked to an average or a compounded rate that is paid periodically. And that in itself will be a striking difference operationally as well. From an accruals perspective, Libor term rates are known at the start of the reset period. SOFR accrual is going to be based on an incurred to date methodology, as we've seen, or other derived methods. In terms of the evolving market, Libor is largely a known quantity, but SOFR, for example, and many of the replacement rates continue to evolve from a market perspective. And we expect to see that from a structure perspective, term structure, product innovation, deepening liquidity, supply and demand forces as well. And all of these together will continue to shape how the new alternative reference rates evolve over time. Now, moving on to the next slide, you then find the global IBOR transition program at a glance. Globally, transition programs are at different levels of maturity. Most banks in Europe and America have completed their impact assessment and have started their remediation. Now, when you think about it from an Africa perspective, the impact assessments are just being initiated or are currently ongoing. When we drill down further to an East market area perspective, we find that banks in the East African market area have initiated transition programs and plans to understand the Libor transition. However, only a few banks within the East market area are driving their transition projects across the critical aspects and work streams that you expect them to consider regarding the wide impact of Libor transition on the entire business. So when you think about work streams around treasury, risk management, systems and change, communication and client outreach, accounting, tax, and regulatory reporting, there's quite a bit to do regarding assessing holistically the impact of Libor transition on the business. I would also note that one or two reserve banks or central banks in the East market area have also issued letters to banks within their jurisdiction or regulation regarding their expectation on transition away from Libor. Now, that is a brief introduction on Libor and the replacement rate. The next agenda item in this section on the market developments, I will briefly highlight some activities across the markets in preparation for the transition away from Libor. Like I mentioned earlier, Libor's end has truly come, and no new instruments are going to be issued from January next year on new Libors. You will have no new Libor issues from January next year. And in preparation for this transition away from Libor, we've seen significant activities in the year. Notably, in March, the Financial Regulatory Body for Financial Services in the United Kingdom formally announced the future cessation and loss of representativeness of Libor benchmarks. And this applies to all 35 Libor settings or Libor rates I mentioned earlier. In addition, regulators across the world, led by the US supervisors, have declared 31st December this year as the end date for all new USD Libor issuances. And in September this year, the FCA also announced the decision to allow the publishing of synthetic Libor rates when it comes to the GBP Libor and some yen Libor exposures, due to the inability to transition significant number of contracts to the new alternative rates before the end of 2021. From a market perspective, even though in the last 3 years, we have seen an increase in USD Libor issuances, it's important to also note that when you think about the impact of synthetic Libor rates, it only applies to a few contracts. And I think the key takeaway is that from January next year, there will be no more Libors. And banks need to be prepared to begin to issue products, enter into contracts using the new alternative reference rates and be able to negotiate accordingly. So even when the synthetic Libor rates are being used, you will still have beyond June 2023, about $68 trillion worth of derivatives and about $5 trillion worth of cash products that are set to mature after 2023. So when you think about long-dated maturities, there is still a huge exposure that might not benefit from any relief provided on the publishing of synthetic Libor rates for transitioning legacy contracts. Therefore, banks need to seek an alignment for long-dated maturities to ensure a smooth transition as well. When you think about SOFR debt and derivatives markets, there's been a lot of activity in the current year. From a debt perspective, the floating rate notes in USD Libor continue to dwindle. However, there is still some market participants, mostly outside the US, that continue to issue Libor-based floating rate notes that mature before 30 June 2023. However, it's becoming increasingly rare to find long-dated Libor issuances maturing after June 2023. From a futures perspective, we continue to see an upward trend in the trading volumes of SOFR futures, while the majority of the trading of SOFR futures is taking place at the CME, and the trading volumes at the ICE have also increased. In fact, in July, the Market Risk Advisory Committee of the CFTC recommended the switch of inter-dealer swap market quotations from USD Libor to SOFR. And just as I mentioned before, truly the end of Libor has truly come, and there is no going back. Now, to the last segment of my agenda, which is the transition impact. Here, I will discuss the readiness and implications of the Libor transition for banks. To start us off, I will discuss what makes the transition from Libor so difficult, and I will highlight what makes it quite challenging. A major reason is the magnitude of products and contracts exposed to Libor. So it is ubiquitous, affecting virtually everyone, everywhere. Globally, we are looking at approximately over $350 trillion worth of exposures across the 5 currencies that are indexed to Libor. From a USD Libor perspective, we are looking at approximately over $200 trillion as well. So that's one major reason why the magnitude of the products impacted begins to pose a challenge for the transition program itself. You also find that Libor transition and Libor itself will impact all aspects of the organization. The business side, the operation side, your treasury and risk functions will also need to prepare for a post-Libor banking environment. And your customers as well and clients are equally going to be exposed. So where you have offered products or entered into contracts with corporate clients or customers, social entities and governments, you would also need to think about managing that transition with your stakeholders. Next up, there is a high degree of uncertainty due to the short time frame for transition. Like I explained, Libor is coming to an end at the end of the year. There are also key aspects of the alternative reference rates, such as the term rates, disparities across currencies, liquidity, legal claims and issues, and remediation that could pose a challenge. For example, we have seen some banks take the opportunity of contract remediation to look at the holistic relationship they have with their customers to amend other aspects in light of the current uncertainty in the environment in which they do business. Now, those will need to be thought about in line with the accounting requirements to see whether they can partake of some of the IFRS 9 reliefs that have been provided by the accounting bodies. And I say IFRS because that is the common business language in the East market area as well. The role of regulators and governments also need to be thought about. We have seen markets in other jurisdictions actually develop legislation to deal with legacy Libor contracts, where there are challenges transitioning due to the fallback clauses not being good enough to aid transition away from Libor. And when you think about the general capacity of the industry, even from an East market perspective, you then begin to appreciate the complexity and the challenge of transitioning away from Libor. Finally, there are operational challenges and complexities as well. The development of curves will also be a challenge using the new alternative reference rates as those also evolve over time. Dynamic dependencies on market evolution. There are dependencies from an accounting, a tax, and regulatory relief perspective as well. And just the multi-jurisdictional aspect to transition. The mere fact that what impacts one territory could have a spill-on effect on other territories as well. And therefore, banks need to be prepared to manage this impact as well. Moving on, I would then talk about how the impact will affect the entire organization. It's critical to understand the organizational-wide impact that Libor transition will have. This will range from business strategies, client management, and operational processes and technological infrastructure across board. Banks are to expect their product and business lines, as well as corporate functions, to be equally impacted as well. I mentioned the legal documentation, client communication, and remediation that you will need to think about, and just planning ahead for the full spectrum of the impact. And this begins to give you a sense of the kind of cross-multidisciplinary team involving different functions across your banks that you will require to manage the transition away from Libor come 1 January 2022. Now, from an end-to-end perspective, I outline on this slide what organizations like yourself need to do from an end-to-end perspective to be ready for the cessation of Libor at the end of the year. Now, the very first thing is ensuring that you have your proper project management setup. So you want to ensure that you have the proper governance structure in place, mobilize your Libor transition program, your governance structure and work streams, like I mentioned earlier, draft your overall transition roadmap and budgets, define your transition scenarios, and develop your risk mitigation strategies. Now, following that, you will then need to think about conducting a qualitative and quantitative impact assessment across all business areas and functions. Develop a process to monitor Libor exposures on an ongoing basis. Next to that is new benchmark markets and product transition. As a bank, you need to define your new business strategy for transitioning your legacy products and developing new risk-free rate products, including evaluating the economic impact and the new product approval process as the rates within those contracts evolve over time. Next to that is to think about contract remediation, identifying and having an inventory of the affected contracts, developing a contract remediation strategy for different types of contracts, and renegotiating as appropriate, including updating contract language for new deals. Next to that is thinking about your client strategy, outreach, and communication. Developing a client strategy, including client segmentation, taking advantage of client and relationship opportunities, and segmenting your clients based on the type of impact that they have as a result of the transition away from Libor. Managing internal and external outreach, education, and communication remains paramount as part of the transition process. Next to that is systems and process changes. Defining the requirements for and implement system changes and processes, including vended solutions, market data feeds, and business processes to enable alternative reference rate processes. That becomes very important. In fact, I will add for treasury functions that have feeding rates, for example, from Bloomberg, Reuters, you want to also check with your vendors to ensure that the current license you have under the Libor regime remains valid to help you get your feeding rates under the post-Libor environment. You want to ensure you have the right licenses to continue to trade and do business post-Libor being taken away. So you want to make sure you are actually engaging from a systems perspective as well. Models and risk management, those will need to be updated, revalidated from a pricing and risk management models perspective, including curve constructions, discounting, and valuation, using the alternative reference rates, assessing the impact, mitigating also the impact where necessary. And then finally, financial reporting and tax. Updating the financial reporting and accounting process in accordance with the industry guidance. As I mentioned earlier, the common business reporting language being IFRS in the wider East market area is what we will then be using as an accounting, from an accounting perspective or financial reporting perspective. Also an evaluation of the tax impact and any update to the strategy to mitigate those impacts. Before I close, I will just go back quickly to the accounting perspective, where from an IFRS perspective, 2 amendments have been issued in 2 phases. One applicable, the phase 1 was applicable 1 January 2020, while the phase 2 was applicable 1 January 2021. Those amendments from an IFRS 9 perspective provide relief as part of this transition. However, to qualify for those relief, you need to meet certain criteria. For example, the amendments or remediations to your contracts need to be directly as a result of the Libor transition. And whatever reference rate you are going with post-Libor needs to be deemed economically equivalent. There's a lot of judgment involved in some of this analysis, but it's important to note that where you don't qualify for the relief, there could be some impact on your performance statement. In other words, a P&L impact to also watch out for. So it's important for banks to ensure they have the right work streams from a legal, treasury, systems, risk perspective, accounting, tax, and regulatory reporting as well. So those are, from an end-to-end perspective, the things you will need to think about. And that brings me to the end of my presentation. Thank you for your time and attention. Have a good afternoon.
Good afternoon to you all. And thanks to TDB and the ERB for inviting me to the stage. I know it's been a long day, so I will keep it short. But I like to take the opportunity to inform you about a course that we have been developing. Next slide, please. Yes, a few words about AFC for those who don't know you. AFC is a German consultancy established in 73 and specialized in agriculture, agribusiness, financial sector development. The background of developing this course was a longer term project that we implemented for the EIB between 2014 and 2020. And the last activity of the project was actually to develop this course. So we launched the course recently, doing a pilot currently with some of the banks, and this course is really an introduction to agricultural finance for bankers, especially those banks based in Africa. And the idea is to introduce loan officers and other bank staff who are fairly new to the topic of agricultural finance to what it is about. So the course is meant to be very interactive. We have inserted lots of videos, infographics, courses to do, texts, interactive assessments. And for those who want to dive into the topic a little bit more, we have a lot of additional reads and links to those reads made available. The 4 modules that the course is made up of have exercises, different types of exercises, and each module has a summary sheet at the end to check, of course, and summarize the knowledge that hopefully people will have gained. On the next slide, I will show you what the modules are made up of. Can you help me because my tool is not working? Yes, thanks. Quickly on the first module. The first module is really an introduction to agri-finance, where we set the stage for agriculture. Why is it important? How can we as financial institutions play a role in agri-finance? How do the agricultural value chains work? How are they made up of? Who are the actors, and what are the financial needs of those actors that we want to work with? Second module is about risk management, and dives into aspects of risk that play a role at customer level, but also at financial institution level. Especially, we're looking into loan portfolio risks. but also environmental risks, social risks. There, the participant, the learner, is taken along on how to assess those risks and how to select the best risk management strategy possible. So we have exercises available for stress testing and portfolio monitoring. Next slide. The third module really takes the learner through the whole cycle of loan management, starting with loan appraisals, ending with hopefully disbursement repayment in time, and it gives a special attention to financial analysis during appraisal and for proper allocation of those loans. Fourth module is about types of products, innovations that we see in the agricultural field. We tackle the main loan products, but also products as loan products, also products as insurance. We look into trade finance, leasing options, and pay special attention to value chain finance, where we dive into how tripartite models work, warehouse receipt systems, and warehouse receipt finance. We have an aspect of climate finance and look into digital financial services. What are the tools? What are the benefits? How can financial institutions use those tools for the clients? Or how can financial institutions promote the use of the tools by these clients? Next slide, please. Yes. As I indicated, at the end of each module, there is a summary sheet that gives also a sort of interactive way of what the module is about. And well, this was a very brief glance, but the course itself is quite intensive. It's about like roughly 9 hours to fulfill. At the end, the participants can go through a quiz, and with enough questions correct, he can or she can earn a certificate. This course is not developed for commercial purposes. It's really developed for those partner institutions of the EIB. So we welcome you to either contact us or contact the EIB directly if you're interested in participating in the course or have your staff members participate in the course. Yes. Next slide, please. That's it. It was a very brief glance through. Thank you for your time.